Dear clients, I'm Richard, Senior Phillip CFD dealer. A late rally last Friday lifted the S&P 500 to yet another record closing high, effectively erasing trading losses accumulated during the week. On top of that, the benchmark equity index had earlier rallied 3.8% in the month of August, the biggest increase since February, and it was accompanied by a 30% month-on-month dive in VIX, commonly known as the Equity Fear Index, down to the 12th handle from 17th. Such resilience exhibited by the equity market may be attributable to a somewhat benign backdrop of 1. A continuous geopolitical de-escalation efforts in Ukraine and in other pockets of unrest, as well as 2. An unexpected ECB policy easing announcement on last Thursday, which includes a 10 basis points reduction of its policy rate and a targeted asset purchase plan, which only stopped short of a broad-based QE program. However, as discussed in my last commentary, the confluence of market events has encouraged market participants to trade too dovishly. Therefore, expect markets to hunt for shift in economic data trends and/or policy guidance in search of further market directional drivers. Thus, in view of diverging global economic trends, with relatively more robustness in the US underlying economic momentum versus, say, Europe or Japan, a policy divergent risk arises. In other words, the Fed may have to consider whether to author their guidance on the likely path of interest rates during the 16 to 17 September FOMC meeting, which is just days away, and that prospect has been keeping many markets nervous. To illustrate the market impact of policy divergence risk, I would like to draw your attention to some cross-market actions highlights. In particular, the recent emergence in the forex world of a strong USD uptrend signals that market participants might be underpricing the US interest rate trajectory. For example, the Bloomberg Dollar Spot Index, which tracks the US currencies against 10 major peers, is currently trading near 40-month high. Euro US dollar is having its longest losing streak since the euro began trading in 1999, and the USD leapfrogged to a 6-year peak against the Japanese yen, a reflection of an increasing divergence between the Fed and the other central banks. The policy divergence risk has resonated across markets, with the commodity complex clearly bearing the brunt of the stronger US dollar. For instance, gold sagged to a 3-month trough, and the Brent oil settled below the $100 mark. In general, USD strength makes dollar-priced commodities more expensive in terms of other currencies, hence dragging the Bloomberg Commodity Index to its lowest level since January. The 10-year Treasury yield advanced to the 2.5% level, up from a low of 2.3% touched in mid-August, also buoyant by the potential for higher US interest rates. To sum up, market participants are shifting their focus towards the end of the US QE program, which is on track to end next month in October. As such, equity market participants also need to stay nimble and should consider harvesting some gains. This is to avoid being caught off guard should concern over premature tightening heighten during the bumpy transition away from an era of excess liquidity. Nonetheless, the base case argument remains that policy makers should eventually stir us via a measured normalization of monetary policies towards a destination of stable global growth. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Richard from Phillip CFD. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.